Welcome to Real World Real Estate, where we will explore, examine, and explain the real process of buying or selling real estate. Here is your host, Stephen Clyde.
Hey everybody, welcome back to Real World Real Estate. I'm Stephen Clyde, your host. I'm with RE/MAX Preferred, RE/MAX of Cherry Hill. And we're going to do a quick little market update today, and we're going to talk about the market conditions moving forward as we progress into more lockdowns and additional COVID cases and everything that's happening across all the states where we're not seeing any relief from this. So we're going to touch on how that's going to affect the market moving forward and what we have to worry about or be concerned about, if anything. First, I want to talk about our market conditions. And fortunately for sellers, but unfortunately for buyers, the market conditions really haven't improved that much at all. We still have a severe inventory shortage. Right now, we are down 63.4% in our inventory compared to July of last year, which means we have 36% of the homes on the market that really should be on the market. Compounding that, we have an influx of new buyers coming into market areas, specifically those outside major metropolitan centers or major cities. In North Jersey, they're seeing an exodus out of New York and New York City into the North Jersey suburbs, and Connecticut's experiencing the same thing. Down here in South Jersey, we're experiencing that with Philadelphia, where we're getting an exodus out of the city into the South Jersey suburbs. Gabrielle and I did an open house Sunday, and half of the people coming through the open house were coming from the city. They were coming out of Philadelphia looking for a house in the suburbs. They were looking for a little bit more space. They were looking for a little bit more safety and security because of all the rioting and everything going on. But they were also looking for the space. That was the biggest thing, and outdoor space, because they were quarantined in their condos or their row homes for so long that they realized they did need more space. So that influx of buyers that we didn't anticipate and weren't anticipated back last quarter or even the quarter before that coming into the market, compounded with our lack of inventory situation, is creating havoc for buyers trying to look for homes. Every house is a bidding war or highest and best situation right now. So if you're out buying right now, I would suggest get all of your ducks in a row. Make sure all your I's are dotted and your T's are crossed. You've got your pre-approval ready. You've got your proof of funds ready. You don't have another house to sell. You've cleared a contingency, and you've got yourself positioned to present the best offer. And right now, the best advice I can give anyone is go in at full price and hope that you can hold the deal there, because most are going for well over asking price. We've seen some transactions where within 24 hours, there's 7 to 8 offers on a house. I was out last week showing houses and literally had to stand in line. We social distance by 6 feet, but there were 6 agents with their clients there to show the house, and we all had to wait in line to get in and look at the house. So it's great for the seller. This is a real problem for the buyer. So make sure you are ready to go. You've done your homework. You know where you want to live. You're hyper-focused, and you are ready to pull the trigger as soon as you see the house you like. Don't delay and don't put it on the back burner. So we've also seen an increase in value, obviously, because of those bidding wars and because of that lack of inventory. So in South Jersey alone, Ocean, Mercer, Camden County, Burlington County, Salem County, Cumberland County, we've seen a price appreciation in the last 12 months of 4.2%. And that's strictly because of the lack of inventory. And we're seeing growth. The days on market have dropped drastically. Luckily, new inventory coming onto the market is increasing. So in April, we only had 1,900 new listings come on the market. That number's back up in June to almost 3,400 new listings, still well below where we need to be. We should right now have 15,650 homes on the market, and we've only got 5,732. We've got an increase in buyer and a lack of inventory, so it's a perfect storm. And market accumulation right now, or the inventory accumulation, is at 2.2. which means we have 2.2 months supply of homes currently on the market. In a perfect world, that is between 5 and 6 months. That's called neutral or balanced. So, like I said, get your ducks in a row. If you're thinking about selling a home, now is the time to put that house on the market. You have no competition. You have tons of buyers lining up to come see your home. So the sooner you can get it on the market, the better, right? This is the time to put your house on the market. And it's also the time to buy, right? Because interest rates are still below 3%. Prices are still good as compared to a cost of living situation. So it's a great time to buy, but it's really an amazing time to sell. So we'll keep you posted on the market. Hopefully we get some kind of adjustment in this inventory over the next 2 or 3 months. I hope it gets up to at least, we're only down 30% and not over 60%. I don't think we're going to see a full relief on the inventory problems for several years, but it shouldn't be this drastic of a problem. Hopefully, and that's all going to depend on how we proceed with COVID-19 and the quarantines and the lockdowns. All right, that being said, let's talk about something I actually talked about a couple episodes ago when I debunked Suze Orman. But I want to go into some of the real facts here as far as with what's going on in the health crisis we face right now across the country. And we still have an increase in COVID-19 cases. We have different states imposing different restrictions and going back into lockdown mode. It's happened across the country, region by region. And it's really affecting businesses across the country, right? Some have been forced to either reduce or completely discontinue services altogether. This pause that we've had in the economy for the last 4 months now has greatly impacted the workforce. And as a result, many people have been laid off or they've been furloughed. And naturally, in a normal circumstance, that would lead us all to believe that we're going to see a rush of foreclosures like we saw in 2008. But the market today is completely different than 2008. And I can't stress that enough. This is a completely different economic environment than 2008. This is an outside phenomenon or pandemic that's affecting the economy. In 2008, the housing market caused the financial crash. That's why we saw such a huge amount of foreclosures. And also there was a total lack of equity in the homeowners' properties. So they had less options or they had less ways to maneuver other than going directly into foreclosure. The concern of more foreclosures based on, all of those that are out of work, we need to understand this, fully. There are basically 2 reasons why we won't see the rush of foreclosures this fall. And for forbearance extensions and strong homeowner equity are the 2 biggest reasons. And obviously the marketplace right now with the buyer's confidence and the lack of inventory is driving that as well. But the forbearance, according to Consumer Financial Protection Bureau, the CFPB, is when your mortgage servicer or lender allows you to temporarily pay your mortgage at a lower payment or pause paying your mortgage completely. All right. This is an option that was not available in 2008 to homeowners. They either made the payments or they went into foreclosure. There wasn't a forbearance option in there. And this option is for those who need immediate relief. In today's economy, the Consumer Financial Protection Bureau has given homeowners a way to extend their forbearances, which will greatly assist those families who need it at this critical time. If you go back and listen to the debunk episode about Suze Orman, she talked in her Facebook post that the 3-month forbearance was expiring this month in July, which was true. But that was changed, right? As we progressed, that was the initial forbearance that came out in March and April. Basically in April, and it gave you a 3-month stay on your mortgage, basically, or forbearance. Well, now due to the hardship, if you're experiencing a hardship due to the coronavirus, you have the right to request and obtain a forbearance up to 180 days or 6 months. You also have the right to request and obtain an extension for an additional 180 days. So that's a total of 360 days or just shy of a full year that you can request that forbearance. Now, keep in mind, prices have gone up. Homeowners have equity. they have ways to get out of this situation that they didn't in 2008. And really the biggest one besides the forbearance, which is protecting them, right? Normally, if you were 3 months behind, the bank is already ordering the foreclosure process. You've already received your notice of default. You're already behind the 8 ball, and try to dig back out of that is difficult. This time around, the banks are working with you. They gave you that initial 3-month forbearance to get through the initial lockdown and the quarantine. Now we've got 280-day forbearances that we can take advantage of if you're still laid off, if you're still furloughed, right? So we've got great tools there alone to work with to stop the foreclosure pandemic, right? Creating another pandemic through foreclosure. And equity is also working in favor of today's homeowners. This savings is another reason why we won't see a substantial foreclosure in the near future. Today's homeowners are in a forbearance actually have more equity in their homes than what the market experienced in 2008, right? Mortgage Monitor report, the Black Knight, indicated that of all the active forbearances which are past due on their mortgage payments, 77% of those homes had at least 20% equity in their houses, right? So actually 59% of them had more than 30% equity. 18% had between 20 and 30% equity. 13% of people had between 10 and 20% equity. 9% had from 0 to 10% equity. And only 1% of people that were in forbearance right now and deemed behind on their mortgage payments had negative equity. So let's put that in perspective. If you have a $200,000 home in today's market and you're in the majority, at 20% equity, you have $40,000 sitting there. It's going to cost you between 6 and 7% to sell your home between closing costs and taxes and commissions and everything. So 7% of that is $14,000, but you have $40,000 in equity, right? So you get $26,000 that you can sell your home, walk away with $26,000, and make the financial adjustment you need to based off of how your circumstances changed during the pandemic. So this equity is a huge factor, right? This equity did not exist in 2008. There was a lot of negative equity in 2008. And even if there was a reversal in the real estate market, which no economist foresees anytime in the next 5 to 7 years, but let's say there was a 5% drop in the market in the next year due to what's going on right now, right? None of us can foresee it, but let's look at an unprobable and unlikely event, but let's say there's a 5% drop in prices. Okay, well, that $200,000 home we just talked about is now worth $190. Okay, your mortgage balance was $160. It's still going to cost you $14,000 to sell it. So you're still going to make money. You still have profit and equity built into that home, even with a drop in the real estate market. But what we're seeing right now is an increase. More likely by the end of the year, that $200,000 home is going to be worth $210,000 or $208,000, especially if we stay on the same track we're on now with getting between 4 and 5% pricing growth in the market year over year. So there really is no reason for us to anticipate any type of foreclosure issues coming in the fall or even through the winter and the spring at this point. This high level of equity provides options for homeowners, provides options for policymakers, for mortgage investors, for servicers. And these options give them the tools they need to help avoid a downstream foreclosure activity and default-related losses. Many think we may see a rush in foreclosure this fall, but the facts just don't add up in that case. Today's real estate market is completely different than 2008, when we saw many homeowners just walk away when they owed more on their homes than their homes were worth. We're not there now, right? Over 77% of these people have 20% equity in their homes. You're not going to walk away from $20,000, $40,000, $60,000, $80,000 and just walk away from it. That happened in 2008 because those homeowners had zero equity in the home. They had, as I would say, no skin in the game. There was no downside to them walking away. They didn't lose anything if they walk away. All right. So they're not going to walk away from this money. It's worth too much to them. And the equity is stronger and the plans are in place to help those affected weather the storm, right? No one foresaw, although we probably should have, 2008 occurring, and there were no tools in place to do it. And it struck so fast and it was so far reaching that it was almost impossible to deal with it. When we dipped into that great recession and banks and mortgage companies were going out of business left and right, homeowners were buried underwater in their homes. They had no equity. They couldn't make their adjustable rate payments. It's a completely different scenario than we see now. One, a very, very, very slight and small percentage of homeowners take out adjustable rate mortgages. I have nothing to base this number on. It's just my experience, but I would say over 97% of people that are purchasing homes right now are buying a fixed rate mortgage, be it 15 years, 20 years, or 30 years. That rate is fixed. And no matter what happens to the economy, that number doesn't change. The principal and interest payment never changes. The taxes may go up. Homeowners insurance may go up, but the basis of your payment never changes. That is locked in for that time frame. That was different back in 08. Back in 08, there was a lot of adjustable rate mortgages and mortgages that we called the liar mortgages. So none of that exists today. We've got the tools in place, the forbearance is in place. The lenders and the servicers went through 08. They learned from their mistakes. They have the departments and the tools in place to deal with this now because we went through 08. Thank God we went through 08 to get to 2020, because if we didn't have that experience and didn't get those tools in place and know how to handle these situations, we'd never be ready for now, right? So everything is in place on the servicers end. The governments are working to put the relief in place for homeowners and those that are laid off or furloughed and that are out of work now because of what's going on. But the equity's there and the market's there and everything is working in our favor. So as we go into the fall, I actually see greater price increases. I see that one of the things that normally shuts us down a little bit in the fall as we go from August into late September is the back to school move. Well, from everything I'm reading, that's going to be a non-factor this time around. And it may actually drive the real estate market more. As the new school plans come out, and from everything I've read, they should be coming out in the next week to 10 days across the country. And they're going to be different everywhere, obviously. But I think the way we educate our children is going to change drastically, at least in the short term, at least maybe for this school year, maybe the next, I don't know. But that's going to change our real estate market because normally this is a rush right now before the last week in August to get moved in, get settled in, because we want to get unpacked and we go into the kids on the school bus. Well, if we're doing virtual learning, if we're doing virtual school, that may not be an issue for us driving forward. All right. And I think we're just going to see it keep that actually, I believe will drive the real estate market even more, not hurt it. Because if we're going to virtual learning and schooling, and we're also going to virtual jobs, we're going to need more space inside our homes to do those things, right? So you're going to need your own private space to do your virtual work meetings and your Zoom meetings from your children or your wife or your partner or your roommate, whatever it may be. We need more space now because we're all doing video and Zoom meetings and virtual either classes or jobs or meetings. And we need that separate space to do those items, right? We can't be overlapping each other. We can't be sitting next to each other while we're doing those meetings and interfering with each other's input. So that additional space is going to drive, that additional need for space is going to drive the real estate market even more. And it's going to have a drastic effect on the pricing and the availability moving forward. And I think it's basically going to be for the foreseeable future, because I think there's going to be a major shift in how corporations do business and workspace. I believe that virtual is going to become more of the norm than it ever was before. So that's going to allow people to move and live where they want to live, right? You don't have to live within a half hour of your office anymore because your office is a room in your house, right? You don't have to worry about being near the train line or near the bus route or what time I can get over the bridge or through the tunnel or whatever it may be when you're dealing with commuter traffic and that extra half hour to an hour to get back and forth to work every day, that's gone, right? Your office is basically going to become, for most people, a space in their home. The downside to it is the classroom for those of us that have children is going to become space in the home. So you may have only needed 3 bedrooms before, but now you need 4 bedrooms plus a den to accommodate these virtual work and learning scenarios. So these factors are all going to drive the market stronger moving into the fall and the winter. Those compounded with interest rates at 2.75%, 3%. I mean, these are historical lows. So that's going to continue to drive the market. And then we factor in what I talked about before, those buyers that are exiting the city centers. They're now putting more pressure on the suburban markets. So all these factors combined, added in the tools and the programs that are in place now for forbearance and release for homeowners, we're not going to see the foreclosures that we saw in 2008. We're not even going to see a small taste of that foreclosure market. Stay tuned. We'll see you on Tuesday and have a wonderful weekend. Talk to you then. This is Stephen Clyde, your host of Real World Real Estate.
Thank you for tuning in to this week's episode. If you would like any additional information, please contact us at Team Clyde Realtors on Instagram or Facebook, or you can send us an email at Stephen@TeamClyde.